Welcome to Talk Tickers. Today, we're digging into Chipotle's latest earnings report and, more importantly, the market's pretty surprising reaction. So let's just jump right in. So, Chipotle reports their numbers, and this is the figure that immediately grabbed everyone's attention, minus 7%. That was the stock's knee-jerk reaction in after-hours trading. The big question is, what went wrong? All right, to figure out why this stock dropped, we've got to first look at the headline numbers. The stuff that drove that initial market reaction. And here's the puzzle, because on the surface, everything looked pretty solid. Chipotle actually beat what the analysts were expecting for both earnings per share and for revenue. That's a classic beat on the top and bottom lines. But, that's really where the good news ended. This was a classic case of the numbers looking good, but the story behind them, not so much. And the market saw right through it. And this really gets to the heart of the problem. Yeah, comparable sales were down 2.5%. But the real story is why. Transactions, that's the number of people coming in, fell a pretty steep 5.4%. To put it simply, a lot fewer people were walking through the door. And that drop in customer traffic, well, it wasn't just a one-time thing. It's really the central theme of this whole report, and it's the key to understanding where the company is headed from here. To their credit, management wasn't trying to hide from this. They came right out and called 2025 a reset year for demand and traffic. They're basically acknowledging, hey, we know the consumer environment is tough right now. This visual explains perfectly how they still managed to beat on revenue. So they had that 5.4% drop in customers, right? But they made up for it by getting people to pay more. The average check size went up almost 3%, so those price hikes were really just masking the fact that foot traffic was down. And this whole dynamic of having fewer customers, well, it also hit their profitability. Restaurant-level margins, which is a really key metric for how efficiently they're running their stores, fell by 250 basis points. That's a 2.5 percentage point drop from last year. Okay, so we've established it's a reset year. The natural question is, what's management's plan to turn things around? Let's take a look at their playbook and what they told us to expect for 2026. They gave us three main things to think about. First, and this is the one that really hurt, they guided to flat comparable sales for the whole year. For a market that was hoping for a big comeback, hearing flat was a massive disappointment. On the bright side, they're still expanding like crazy, planning to open 350 to 370 new stores. And they'll keep raising prices, but just by a little bit. And beyond just the numbers, they talked about their strategy. They're leaning into this idea of a K-shaped economy, where wealthier people keep spending, but lower-income folks pull back. So they're focusing their marketing on those higher-income customers. They're also going to speed up new menu items, try to get more efficient with new equipment, and give their rewards program a makeover to get people more engaged. So what we have is a weak traffic trend and some pretty cautious guidance from the company. Now, let's connect that all the way back to that 7% drop by looking at how the stock was behaving before this report came out. I mean, this chart really says it all. In just the 3 months leading up to this earnings call, Chipotle stock had shot up over 24%. Meanwhile, the rest of the market was basically flat, so expectations were just through the roof. The stock was priced for perfection, and there was absolutely zero room for any bad news. Now let's talk about a little bit of market jargon here, the implied move. All this means is it's the size of the stock price swing, whether it's up or down, that the options market is kind of betting on after an earnings report. So for Chipotle, the implied move was about 9.5%. The stock fell 7%. So while that drop was definitely sharp and painful if you were a shareholder, it was actually inside the range of craziness that the smart money in the options market was already bracing for. A big swing was expected. So let's put it all together. What should we, as investors, be watching for in the next quarter? Here's our take on it, analyst style. So what's the trade here? How should we be thinking about Chipotle stock from this point forward? Okay, for the next earnings call, we're predicting that comparable sales will still be negative, probably in the low single digits. I mean, if management is guiding to flat for the whole year, that kind of implies the start of the year is going to be tough. Because of that, we really see the stock as being stuck in a range, pretty neutral until we see a clear sign that customer traffic is actually turning around. And so that brings us to our final take, a market perform rating. And the logic here is pretty straightforward. The long-term growth story, opening all those new restaurants, that's still there. That's intact. But these short-term problems with weak traffic and lower margins, it creates a very balanced risk versus reward situation. We just don't see a ton of upside here until there's real, solid proof that customer demand is coming back in a big way. And as always, we have to end with our standard but very important disclaimer. This is not financial advice.